Today's market call is presented by FactSet, financial data and analytics powered by tomorrow.
All right, Carter Braxton Worth, I'm powered by today. I appreciate you being in here. It's kind of weird. Guy did the intro to the show, but he's not here.
Yes, that's special. Well, he's kind of with us then.
He's always with us. Every once in a while, Guy on Fast Money will say, Melissa, you're in my head. And she's like, oh, I just don't want to be in your head.
Yeah.
A weird place to be. Well, Guy, will be back with us tomorrow. I appreciate you standing in here today. Interesting day in the market. Okay. And I just want to kind of I don't want to put too fine a point on this just because we're down like 25 bips or anything like that. We've had this tremendous run, Carter. Okay. I think we're all in agreement that, about a week and a half ago, it seemed like sentiment was getting really bad. We had just completed what was nearly a 9-ish% peak to trough decline in the S&P, or I guess it was 7% in the S&P, about 9% in the NASDAQ 100. Is that correct?
Or 10.6 if you go peak to trough, but in the S&P, it was legit. It was a proper, and it was duration, right? It was 3 full months.
Yeah. No, I mean, it was just a series of kind of lower highs and lower lows. And we had been looking at your charts and looking at the channel, and you had said to the penny, but we also had another to the penny, you know what I mean? As far as the check back towards that downtrend a little bit. Let's take a look at the NASDAQ 100. You brought some charts here. And, this is one where, early in the week, Carter, I did an options trade on the QQQ. I was seeing a lot of the same things, not as much technically. I mean, to me, that was definitely something that helps me arrive at my decision, but it was more like looking at the names that got us there. And I just felt like, if you thought about the setups into many of their earnings and then the way that they acted as soon as rates came down, to me, that's where the disconnect was. And I'm just curious, is that something that weighs into, on top of just you thinking about this chart here, is that just kind of the disconnect with, because what happened in rates is what you were playing for anyway. You were playing for a move in the 10-year back to 4.5%.
Yeah. So the bets we have on, so to speak, the theme or thesis that oil having extended so much would crack the dollar, rates crack. Yeah. And to some extent, or to a large extent, that's happening. Rates are rolling. Oil has cracked. Dollar, more of a pair of twos, not really breaking, but the ascent has stopped. But the fourth part of the narrative, at least from my seat, is that ultimately equities would give some ground. Now, obviously, we did give ground there in the July, October swoon, 10.6%, but we've got this very substantial ricochet over the past 6-7 sessions, up about 6-7%. And the question is just that: is it just a ricochet and the sequence is intact, headed lower, or is it the beginning of something more enduring? And the very special nature of the strength cuts both ways, right? Strength like this, that's so uniform across all areas of the market and is with gaps, is strength that often one has to characterize simply as this: strength that has to be respected. At the same time, because it has the gaps, it's also a bit impetuous, impulsive, rash, knee-jerk. And we know why. It was very much related to the move in rates. And so to some extent, the market is at a difficult level. And my thinking, we can see that on the NASDAQ charts, is that we basically back and fill here or back away. Now, to be fair, this chart as presented to clients was a day ago. And today we pushed up through that a bit, that line. But we're kind of sitting there. And again, how much of a give back? I think the gaps are in play below. 3 in a row, in fact, in the NASDAQ 100.
Yeah. So what's interesting, and here's a couple tweets from Charlie Bolello, who does really good market work here. And he's saying the top two stocks in the S&P 500, Apple and Microsoft, now represent a combined 14.4% of the index, the highest weighting of any two of those companies, with data going back to 1980. And then this other tweet, I think, is, we've been talking about this, whatever you want to call them, the Mag 7, enormous 8, or whatever. And he's just look at the equal weight. You've been talking about it on We're Charting for a while. I just want to go to this Microsoft chart, because this is one that is
right to the highs.
It listen, there's no way to like, it is impressive. Okay. Like, you know what I mean? Like, if you think back to that high in July, Carter, it was literally It was an intraday move. It was July 18th. We were talking about, we were doing this program Market Call at the time. The stock was in the throes of like a 5% intraday rally that equaled like $130 billion in market cap. Why? They put an announcement out about the pricing of their, Microsoft, Copilot 365 AI enabled tools. That was it. And then you see that sell off there. And, those are our charts, not yours. It clipped that kind of uptrend. It bounced off the 150-day, right? And here it is. It had that gap after earnings. It filled it in a little bit, but right back towards those highs. I think yesterday, Carter, it made a new closing high.
Mm-hmm. Yeah, from the intraday. It's a heck of a thing, a heck of a sell-off, right? A heck of a preceding uptrend, a heck of a sell-off, a heck of a bounce off trend, and now a move to a heck of a level, right? The former high. But speaking to this, but also to, I guess, Charlie's the chart, which is so good, and to talk about concentration. While the top 2 are at a level that's never been seen, we also know the top 10 are that. Now, the first thing to say about this is very important. Markets are always concentrated. If you go back about 50 years, you will find the top 10 stocks average about 20% weight, which is to say they're always winners. It's like in life, they sort out the winners and losers, like in sports or whatever you were in school. This guy gets picked, this guy doesn't. And people dominate. People dominate in all areas of life, which is the natural way. But to put it in context, if over the last 50 years, the top 10 basically average a weighting of about 20%, and now we're at 30 or close to it. So that is the issue, right? Not only these 2, but the bulk of the concentration in the top 10. But Microsoft here and now, I mean, look, if you're tactical, you sell it, having rallied right back to that former high. It's a big move to a reference point, and I think buy, sell, hold, you sell.
Well, it's interesting. So it's a big move back to a reference point. Let's throw up the Apple chart here, because I think this is one that's kind of interesting to me, that, that result and that guidance wasn't particularly great. And as we were talking about it on Fast Money, after the close, as the numbers are coming out and the conference call was going on, the stock went from being down, let's say 1 or 2% to down like 4% on the guidance, right? And then the next morning, like in general, I think last week the market obviously post the Fed meeting had a very different tone with the rate move lower, and everything was bought, and they bought this thing, and they bought this thing to the tune of $168 to where we are right now at 182 or so. I mean, in market cap terms, that is fairly astounding on what was like the 4th consecutive very poor quarter and bad guidance, right? So it says more about investor appetite for mega cap tech than it does about the fundamentals and the valuation underlying. Does that make sense to you?
Yes. I mean, and again, this, to some extent, I think Microsoft, speaking of Microsoft versus Apple, and Microsoft's weighting now is bigger. At least I was seeing that in the SPY. Maybe I saw that incorrectly, but Apple is the one. You'll notice that Amazon is getting back to its Meta, back to its pre-sell-off high. Apple's the one that has lagged, and substantially so. And my hunch is it still is something to avoid or be underweight, certainly relative to the QQQ or Microsoft.
Yeah. Well, and just by the way of, making a single stock bet. I mean, I looked at the QQQ the other day on Monday, and we put a note out, or a video out, I guess, as a break-in for Market Call. And I was looking at a December put spread, 365, 340 strikes in the QQQ December expiration, really playing for a move back towards that moving average and back towards that kind of prior low that we had. So, for me, I just think that, rather than picking a stock, I can pick, an index of 100 stocks or an ETF that tracks it, where 40-some%, represent the top 7 that I think are a bit overdone. But again, it seems like an easy one to play for those looking to chase. You just go for the things that have worked to some degree, but I'm looking to be a little contrarian here. I was not short into this move, but I am getting there now, and your charts have helped me do this. I want to highlight this. This is a note from Doug Cass that he put out on Real Money. And I thought this was really interesting. And again, it's just talking about basically the imbalance of the move over the last, call it, week and a half or so. And there's a lot of folks who come on, financial TV or whatever their platform is, and they're talking about the broadening out. And, you know, by his data, it hasn't been broad by any means, you know what I mean? And, you know, like any day when I'm getting prepared to go on Fast Money, Carter, or where we're getting ready to do this show, I just go and look and I see, you know, I see how financials are acting. I see how energy is acting. I see how industrials are acting. I see how transporters are acting. I see how healthcare is acting. They act horribly. You know what I mean? So all these very cyclical, right? Like, you know, like groups are not acting well. So when you have the sort of outperformance that we've seen in some of these, you know, higher valuation names that feel more defensive, that does not speak to being like bullish or broad in any way.
Right. I mean, growth is defensive, right? They're considered sort of less immune to the economic cycle. And so these highly cyclical things, which are showing the stress. I mean, industrials are now at their 2009 relative lows, the financial crisis lows to the S&P. And the story goes for materials and so many other areas of the market. And that then is just the other side of the concentration. And there are two ways to judge the money flow and unending desire to own Apple and Microsoft and Google and so forth. It is both wise to embrace success, right? These are defensive companies by virtue of their balance sheets and the cash they have and their moats in terms of their operating business. At the same time, it's a fear-based thing, right? It's you don't lose your job if you're a professional by being in the big names. And also, if you're an individual, it's like, you know, heck, I guess if I could put my money anywhere, I'll just put it in these big, safe names. And so it's both a positive and a negative at the end of the day.
Yeah. Well, you just mentioned the relative performance of industrials. Look at this one. This is the last chart from Doug here, and he's talking about the ratio of equal weighted S&P 500 relative to cap weighted S&P 500. This is what we've been talking about. It has fallen to its lowest since September of 2020. Okay, so you know you're seeing that in the major index, and then you're seeing you're just seeing relative underperformance in some of these really cyclical sectors of the market relative to the broad market too, which actually to me makes more of the point that you just don't want to be chasing here. Does that make sense?
Yes, and also again, if it's like an if-then statement, if this is a new bull market, then something's going on that's never happened before, which is, or then small caps should be working. But periods of strength are led by risk, right? People embrace small cap, they embrace higher beta names, and it's the exact opposite. And so that's why we have this circumstance that more than half of all stocks are actually below where they were from their lows of a year ago. It is an odd circumstance, which in many ways it's like, well, it has to get reconciled, and yet it keeps not getting reconciled. That's the thing.
Yeah.
So people say the federal government's debt has to get reconciled. You just keep having more and more. Seems to keep on going. We shall see. You know, there are, as they say, there's a day of reckoning.
November 17th is the day of reckoning. All right, you just hit on crude for a second earlier, Carter. This chart is fascinating. If you look at from that 52-week high that was on September 28th, it was $95. Here we are now at $75. I mean, that is just a crazy move. Now, obviously, we had that move from early October. We got above 90 briefly there. And just, I mean, I'll let you speak to the charts, but first, I really want to get your take on, you've done this amazing job. You do it again and again where, at the highs, you start hearing, the big banks and the big strategists calling for $150 oil. And I remember, last year when it was, above 90, there were calls for $200 oil, you know what I mean? And in your mind, and you've been doing this a long time, when you start seeing new 52-week highs on something that has a tendency to be very idiosyncratic, right? Most of the participants who are keying on this, okay, crude oil, know nothing about it. I know little about it. I don't mean to sound like an expert about it. You know what I mean? But when I see everybody get on board at new 52-week highs and calling for 100% gains because this, that, and the other thing, I usually want to take the other side. What's happened over the last, call it month and a half or so, is an absolute train wreck for both oil bulls, all those folks who've been telling you for a whole host of reasons that it's just different this time. And that really was what the argument was. But also the bulls on economic growth. Okay, because this to me, there's no way that you can have a 95 to 75 move in crude oil and tell me that the global economy is okay.
Right. It's recency is a powerful thing, and extrapolation is a powerful thing, and that is the nature of the herd, so to speak. So if we look at a chart of oil, and we have it there, it was just up. We were at $65 a barrel, and consensus was hard landing, recession, we're going to 50. Of course, when it starts spiking to 80, 85, oh, we're going to 100, just as you say. This note put out today is a follow-up from the note of September 19th, and basically we're pulling the short. So if you see in the chart again, the date of the note, September 19th, fade the move in crude. Now it did go a bit higher. To be fair, it was trading at 92, 93, and went on to 95, as you can see from the 19th. But ultimately, it's been a good one. And now I just think it seems a little overdone to stay short. Now, in turn, that doesn't mean you buy for a bounce, because I don't think that's in the cards either. I just think it's been was overdone, and now it's been re-rated lower to maybe more of a pair of twos here.
Yeah. Well, it's interesting. We've been highlighting the fact that, in the last, month or so, Exxon and Chevron, two of the largest integrated oil player, the two largest, at least here in the US, right? And definitely by market cap, that one had made a $60 billion acquisition, and the other made a $50 billion acquisition. And, the XLE, maybe we can pull that chart up really quickly. And I know you have some charts, but, they were doing that when it was very near its, 52-week highs. And a lot of folks and myself and Guy took a look at it. And from a technical standpoint, maybe we thought the XLE was about to break out. But you see that sort of like activity, corporate activity by these companies, and you got to think like something's got to give there. They're either really excited, you know what I mean, for good reason, or they're really excited for very bad reasons. And the market's spoken. And maybe they can pull up Chevron for a second here, because I think it's interesting to look at Chevron making new 52-week lows.
Yeah,
I mean,
it's rolled over hard.
Yeah, I mean, this is the second largest, name in that index. And so you say to yourself, I mean, I saw your note. I'll let you walk through it here, but the price action in a part of the market that a lot of folks were getting really excited about as an opportunity to, again, broaden out away from the most concentrated things, trying to find new and special themes, right, to invest in at a time where it seemed like AI and a lot of the mega cap tech stocks were probably at their, full of the good news and valuation support and all that sort of stuff. And they wanted it to be energy. Okay. But it's not happening. So talk to me about energy stocks.
Right. I mean, it's such a curious thing. Obviously, energy is such a big part of the economy. So many, hundreds and hundreds of thousands of people employed, jobs, all the things that and the follow-on effects. And yet, strangely, of course, in terms of capital markets, the energy sector's stuck at 3% and 4%, depending on the week, the hour, the month, and two stocks are half the weight. So it is a curious thing. But the energy, whereas we're pulling the short, covering, they're going to walk away, take the profits on oil. Energy stocks look like they have more to go. Well, here's an XLE chart, right? So the XLE is meant to measure the entire performance of the S&P 500 energy sector, and we have a clear trend, and we have now flirting with a breach-in trend, a break-in trend. It doesn't matter whether you call it a triple top or not. It's something that's got ahead of itself, is extended, is now stalling and churning, and is losing its way. And so the second note put out today was, while we believe it's right to cover shorts in crude oil, we believe it's right to press shorts in the energy sector.
Yeah, and let me ask you this, because we just showed that Chevron chart, and again, I'm not, I like the idea of pressing shorts. I usually like to do it on a bounce, you know what I mean, or something like that. Would you be more inclined looking at this long-term chart? And even if you were to look at the XLE on a one-year basis, it's not, it's still well above its 52-week lows versus a Chevron, which we just mentioned, which is nearly, 20% of the XLE, which is making new 52-week lows. So do you try to avoid the idiosyncratic risk of a single name that acts very poor, or you know what I mean? Or do you find yourself just looking at the XLE and saying, this is how I can express this view without this single stock risk?
Well, you get single idiosyncratic opportunity and risk, right? You're not going to ever make as much money long or short an aggregate, an index, versus an individual stock. But then you don't have the risk that you get it completely wrong. And so I think there's room for both. I mean, you take your best shots and you make your high conviction bets. And then you can also do aggregate work, which is obviously the beauty of in the modern era when the ETFs were created, you can trade them. You couldn't trade anything but individual stocks for a long time.
And just to answer that, I mean, you and I think for close to 10 years did options action together, where you would come on and we talk about some catalyst and we talk about the fundamentals, and you would lay out the charts, and then oftentimes you and Mike Coe would come together and marry it all together and do a trade. And, I was in and around that too and commenting on it. One of the things I found really interesting, I started out as a long short equity person, so buying stocks, shorting stocks, and the like here. But, sometime in the late aughts, I was on a derivatives desk and I learned how to kind of marry that skill set, right, with expressing directional views, whether it be single stocks or ETFs and the like. And it's interesting that you mentioned that about, again, the idiosyncratic risk you take in a single stock relative to an ETF, that, that single stock is one component. The risk reward looks very different if you're trying to express that view, right, through an ETF. With options though, like you can find, like I can look at the XLE and I can define a trade or I construct a trade where if everything plays out, if Chevron goes where I think it's going to go, I can actually construct a trade where there's a great risk reward if I was thinking about a put spread or something like that. So to me, that's one of the things that I really enjoy about adding other tools to my investing.
For sure.
Trading
it's all part of the process. That's right.
All right. This is really important. And Doug Cass, and this is heavy Doug Cass day today. He just hit me and he mentioned this, and I think this is a really great point. You were on Fast Money, I think the other night, talking about how you think both yields will continue to go lower. And you already had that call, okay, when it was much higher as yields. But you thought that equities could go lower with yields going lower. Okay. And that has not been the case. At least what a lot of bulls thought is that, we might continue to see yields go lower, but equities are going to go much higher. And you see today, they're both going down together. So let's talk about the potential for this to have a sustained move lower, both equities and yields. Is that something like, where's your target in the 10-year? And then if it gets there, where do you expect the S&P to be also?
Yeah, I mean, low fours, so call it 4.1, 4.2 on the 10-year as at a minimum. And then the question is, does that mean higher stock prices, multiples expand, or is it something different, right? Something to do with Main Street slowdown that is starting to be, I think foreshadowed in the crude market, of course, oil market. But that's the thinking, that ultimately equities, they were re-rated lower aggressively. We know that already, right? Let's talk about our peak to trough. The S&P from its high of 2 years ago, it dropped 27%. The NASDAQ 100 dropped 37%. So and then since the October lows of a year ago, we've had this very substantial rally with the big asterisks on the word rally that only half the stocks were actually up. And so a very curious circumstance. My thinking ultimately is that stocks are sort of, if you can use the word belong, stocks belong at a lower level.
Yeah. I agree in that. And I think one of the bigger things, and we're going to hit this tomorrow when we get John Butters, the senior earnings insight analyst over there at FactSet, in his earnings insight blog. He's talking about the pace in which, Q4 earnings have come down, okay, over the last month or so, and much greater than over the last, let's say, last consecutive Q4s, but we haven't seen 2024 S&P estimates come down at all, really, and we're still expecting at least 12% or something like that. So again, I think that's really interesting. All right, last thing before we get out of here, Disney reports after the close tonight, and this one's kind of interesting. 6% implied move in the options market on average over the last 4 quarters. It's moved about 7%, and again, this is one where there are just so many moving fundamental pieces about what they might sell, what they're buying, how they're reorganizing this group. You know what I mean? Like what they're doing with the ESPN. I mean, the list goes on and on and on. And I think, a lot of very astute, market folks have just said that this is just one of those really complicated fundamental situations that's really hard to put your finger on. Help us think about the charts. And then I think in line with what you're thinking about with the charts, I think I have an options trade that will help the people define their risk and play it alongside what you're thinking about post earnings.
Yeah, I mean, just in terms of the fundamentals, we all know it gets down to one thing. I mean, how do you value an enterprise like this, right? Obviously, you can look at its cash flow and you can try to put a discount rate on that. But talk about a disparity between the price to book intangible book, right? I mean, yeah, you sell the land and you sell all the Mickey Mouse ears and you got what you got. But there's an intangible here that is unlike any other, really, perhaps in the world, because anyone could have an amusement park, right? But it would be called Pisney or Lisney, but not Disney, right? And so that is the great conundrum. And I cannot know, you cannot know, but there will be people who will buy it here who have a 10-year horizon and say Disney dropped 67%. It went to its COVID low and I bought it. And guess what? I tripled my money. And other people say, no, it's damaged goods. It'll never come back. The mighty Disney is impaired. I'm in the former camp that ultimately Disney is an enduring asset, and that down here at 67% from its peak, it's money good, right? But let's look. And so now charts have nothing to do with anything I just said. A chart is a chart. And what we have here is a well-established downtrend line where it drops 67%, and we're just starting to poke our head above that downtrend line from Disney's peak in early 2021. So the line is well defined. We know the percent decline, 67%, but this day-to-day basing, right? Now look at the next annotation, and let's flash that. This is happening right at those lows. And one can say, yeah, and it's going to report and it's going to crash out through the bottom and make new lows. That's a bet. My hunch is otherwise. Let's do another iteration. You can see there, it's really a sort of a minor formation for now, but it is a double bottom. And the fact is that it's happening right at the COVID low. And so maybe one more, put the downtrend in, and this, I think you make the bet. But like all bets, if you're betting on an event, in this case earnings, if it's right, it pops, run, grab it. If it's wrong and it drops, run, grab it. And then finally, this is an all data chart. And that's a heck of a trend line. So a 67%, let's talk about the circumstance at hand. A long-term winner, bottom left, upper right, that is sold off 67%. And that 67% sell-off leaves it down to the penny, to its all data trend line.
Yeah.
90 bets.
Yeah. And again, this is a great example of where, we were just talking about trading options and defining your risk. I mean, I think this sets up pretty well again, because I think the fundamentals, even on a day like this is really important. Look at Warner Brothers Discovery. It's down, like 15-16% today. And look at the headline from David Zaslav, who's considered he's right up there with Bob Iger, right?
Yeah.
Just gotta look at that quote right there. Okay. He sees a generational disruption, and that is not obviously that's something that, the folks at Disney are feeling too. So again, I have no idea what they're going to report. I have no idea what they're going to guide. But if you agree with Carter and you're thinking about these charts and you're thinking about the potential for it to pop, I think defining your risk, okay, I think into the print makes a lot of sense. Now, I just want to make one point. So there are options that expire on Friday afternoon. When we talk about what an applied move is, I'm taking the at the money straddle. The stock's basically 84-ish or something like that. And it's about $5. That means the call premium on the 84 call is about $2.50. And then the put premium at that strike is also about $2.50. So you do the math there, it's about 6% in either direction if you were to buy that straddle in the weekly. But I don't think that makes a whole heck of a lot of sense, because if you buy, let's say, the 85 call for $2.25, if that stock is $84.99 on Friday's close, you lose, that 3%. That's not a great risk reward to me in that short period of time. So I want to look at December expiration, okay? And I want to basically play for a move back to that May gap that was after earnings. So today, when the stock was trading around 84, you could look at the December 85.95 call spread, paying about $2.70 for that, buying one of the December 85 calls at about $3.40, selling one of the December 95 calls at about 70 cents. You have profits up to $7.30 between 87.70 and 95, with a max gain of 7.30 above 95. Losses of up to 270. Okay, so think about that. Losses of up to 270. That's very similar in price, right, to that at the money weekly call, right? But I'm giving myself over a month and the event, okay? So I can lose up to that 270 between 85 and 87.70 with the max loss below 85. So I'm risking about 3% of the stock price, with break even up about 4.5%. And I have a max gain of close to 9% in a month if the stock is up 13% between now and December expiration. And I'll just make this point, is that, Bob Iger came back early in the year. He's been given some time here. The stock has not been trading well by any means. To Carter's point on the charts, it got down to that COVID low, right? And it's been banging around a little bit. If there's anything good to say, I think the stock's going to be on its way back to 90, and who knows what it could look like over the next few weeks. But 95, Carter, to me, probably looks like a good level where if you caught this thing, you might want to find yourself on the way out of it and say, wham, bam, thank you, ma'am.
For sure. And that's a huge move from here. So we'll see. Even 90 wouldn't be bad.
Yeah. All right. Listen, Carter, we really appreciate you stopping in here today, spending the time with us. We love your charts. We love your commentary. You guys can find more of it at worthcharting.com. Nothing slick, just charts. We appreciate it. We'll see you back next week. Thanks so much, Carter. All right. Thanks to everybody. Tomorrow, Guy and I will be back with Liz Young. That's EY from SoFi, 1 p.m. Eastern time. We appreciate you spending the time with us. Also, we're putting new content out on Instagram, on the reels. Guy is on the gram, as he said yesterday. It's guy.adami. You can follow Risk Reversal Media. That's also on the Instagram. I am Dan S. Nathan. So check that out. We're going to try to put more and more stuff on there. So we appreciate that. And obviously go to our YouTube channel. You're there now watching it. Smash the like button, leave a comment, follow us. Thanks so much for being here. We'll see you tomorrow.